Hello and welcome back to the Note. We have a landmark for you today. If you take a look at the first chart, you can see that the S&P 500, the world's most tracked index, has passed the 2,000 barrier today. Perhaps it diminishes that achievement a little if I tell you that it's the 10th time it's gone up through the 2,000 mark, which means, of course, that it's fallen back down below 2,000 9 separate times since it first got there back in August of 2014. Basically, the market has been going sideways for 18 months. What is strange about that is that this has happened even though the price of oil has dropped by about 2/3 over that period. Normally, much cheaper oil would be regarded as a big stimulus for the economy and for the stock market. Instead, this time around, this recovery in the stock market has happened as oil has had what you might call the best received oil price spike in history. If we take a look at this next chart, you can see that Brent crude in red there has had quite a renaissance. It's up by some 40% in barely a month. And you get some hint as to why this is regarded as positive from the way that has translated into strong gains in the Russian and Brazilian stock markets. There are others we could mention as well. But plainly, higher oil prices reduce the pressure on the many large emerging markets that really are dependent on resource prices. You could argue, therefore, that even though higher oil prices do mean greater expense for consumers, and you did indeed today see a fall in the price of the stocks that are particularly dependent on the consumer, such as information technology companies, consumer discretionary companies. Even though it has that kind of an effect at this point, given that people are concerned about a big credit event in emerging markets, maybe higher oil prices are positive. On the subject of higher commodity prices being regarded as somewhat positive, take a look at this next very startling chart, which shows you the price of the Qingdao iron ore contract, the main benchmark for the price of iron ore that's used to make steel in China. It's been in a dramatic bear market over the last few years as China has tried to shift to a new mode of production, a new model for its economy. What we saw today was the biggest one-day rise in Chinese iron ore on record, up almost 20% for the day after the Chinese authorities announced new economic targets over the weekend. You could regard that in some ways as a backtrack on their previous plan that they've been wanting to transition their economy more towards a services economy. Now perhaps they're going to go back towards doing things that require building more steel. That certainly helps steel prices for the moment. They're up by some 2/3 from the bottom. What we now need to see is whether that has a broader effect on sentiment, whether we see a true return to animal spirits, see the S&P begin to get back up to new highs, and whether that has an effect on inflationary expectations, which in turn could change the actions of central banks. The first big information point we'll have on that comes this coming Thursday, when we'll be hearing from the ECB.